Last Thursday, a single jobs report was released. Within 24 hours, over $1 trillion vanished from global markets. No war. No financial crisis. No major company collapsing. Just a monthly jobs number. And here is the part that makes no sense on the surface. The report showed Americans were finding work more easily. The economy looked stronger. But the market reaction was one of the worst single-day crashes in years. So what actually happened? How does good news become a catastrophe? That is exactly what we are breaking down today. Here is what you need to know before we go any further. That headline jobs number that shocked everyone? About half of it is not what it looks like. On June 5, the U.S. Bureau of Labor Statistics released the May jobs report. The economy added 172,000 jobs. Markets had expected around 85,000. The actual number came in at exactly double the forecast. On top of that, the government revised March and April upward, adding a combined 93,000 jobs that were not counted before. Added all together, and the U.S. created 565,000 jobs over the past 3 months, the strongest expansion in over 2 years. Sounds incredible, right? But before you draw any conclusions, you have to ask the most important question: where did those jobs actually come from? Here is the uncomfortable truth: a significant portion of these new jobs will probably not exist by the end of this year. Break the 172,000 down by industry, and 3 sectors account for almost everything. First, leisure and hospitality added 70,000 jobs in a single month. That sounds impressive until you realize the monthly average for this sector over the past year was only 14,000. Why did it suddenly jump to 5 times that level? Most institutional analysts point to one obvious reason: the 2026 World Cup is about to begin. Hotels, restaurants, and travel services are hiring aggressively to handle the surge. But this is event-driven demand. When the tournament ends, the majority of those positions will disappear with it. Economists call this a one-time expansion. It tells you very little about the underlying health of the economy. Second, local governments added 52,000 jobs. Government hiring sounds stable, but it has a fundamental characteristic that separates it from private sector growth: it is driven by budget spending, not by genuine economic activity. Markets generally treat government job growth as lower quality precisely because its sustainability depends on fiscal decisions, not on organic expansion. Third, healthcare and education added roughly 40,000 jobs, in line with expectations. This is a genuine long-term sector, driven by aging demographics and structural demand. No surprises, but no reason for excitement either. Those 3 categories account for the vast majority of the 172,000. That is what the headline number is built on. Here is the signal most people missed in this report: the highest-paying industries in America are quietly cutting jobs. While hotels and government offices were hiring, the financial sector shed 22,000 jobs in May alone. And this is not a one-month anomaly. Over the past year, finance has lost 107,000 positions. Banks, brokerages, insurance companies, asset managers, these high-salary white-collar industries are being systematically replaced by algorithmic trading, AI-driven credit systems, and automated back-office operations. Technology is in the same position. Over the past 17 months, the sector has posted job losses in 16 of them. Software engineers, product managers, data analysts, the so-called tech white-collar class, are being swept up in this wave of AI substitution. There is a critical distinction to make here. The tech layoffs of 2020 were a passive contraction after a valuation bubble burst. That was cyclical. What is happening now is structural: AI actively replacing human labor at scale. The nature is completely different, and the timeline is likely much longer. Wages confirm the same story. Average hourly earnings rose 3.4% year-over-year in May. That sounds decent until you put it next to April CPI, which came in at 3.8%. Wages are not keeping up with inflation. In real terms, purchasing power is quietly being eroded. The overall picture from a business perspective is a hidden structural fracture in the labor market. High-skill, high-wage jobs are disappearing. Low-skill, low-wage jobs are growing. The headline number goes up, but the quality of employment is drifting downward. Picture this. You have worked at a bank for 10 years. One day, a new AI system is deployed. It handles the workload of 5 people on your team. This is not a hypothetical. This is happening right now, across finance and technology, at a pace most people have not yet processed. The Federal Reserve is now caught in a trap with no clean exit. Strong jobs data means the economy is still expanding, which means inflation stays elevated, which means rate cuts are off the table, which means if inflation refuses to come down, the next move might actually be a rate hike. But raising rates further risks crushing the employment and consumer spending that is still holding the economy up. The chain of logic that sent markets into freefall looks like this. Jobs come in too strong. Inflation stays too high. Rate cuts become impossible. Rate hike expectations surge. Global assets get repriced. Markets collapse. One jobs report. One chain of consequences. That is what happened last Thursday. Some people are calling this the beginning of the AI bubble bursting. That conclusion is premature. But there is one thing that is genuinely true. The Philadelphia Semiconductor Index dropped more than 10% in a single day, the worst session since March 2020. Nvidia fell 6.2%. Micron dropped 13.25%. Marvel lost nearly 17%. At the same time, money rotated out of growth stocks and into defensive sectors, insurance, consumer staples, healthcare. This rotation is the most classic market behavior of a rate hiking cycle. But there is a factor most people overlooked. On June 12, SpaceX is set to go public. The fundraise target is $75 billion. The implied valuation is $1.7 trillion. This would be the largest IPO in history. Institutional investors who want a piece of this deal need cash, and that cash has to come from somewhere. The answer is their existing positions in major tech stocks, semiconductor ETFs, and Bitcoin. Selling existing holdings to fund a new allocation is standard institutional behavior around major IPOs. It objectively amplified the selling pressure this week. From the industry side, the long-term logic of AI capital spending has not broken down. The major tech companies are still executing on their data center build-out plans. There is no sign of a meaningful slowdown in global AI infrastructure investment. But one thing has to be acknowledged: when valuations reach extreme levels, any headwind becomes dangerous. Markets spent the last 2 months pushing AI stocks to historically elevated valuations. Now that interest rates are acting like gravity again, even the best story has to come back down to earth. One more thing that has to be said clearly: the non-farm payrolls report has a well-documented history of being revised substantially. This month's number is not final. Just this time around, March and April were revised upward by a combined 93,000 jobs, nearly equivalent to an entire extra month of employment growth that was not previously recorded. Nobody knows yet whether the 172,000 figure for May will hold or shift significantly next month. A single data point should never be the basis for a long cycle conclusion. 3 dates matter in the near term. June 10, May CPI data is released. If inflation also comes in above expectations, rate hike odds will rise again and markets will face another shock. June 12, SpaceX officially begins trading. The capital reshuffling effect continues to put direct pressure on tech and semiconductor positions. June 17, the FOMC meeting. New Fed Chair Kevin Warsh makes his first appearance as chair following this report. Every word he says will be amplified. The baseline market expectation is that he signals a hawkish lean without actually hiking. But even a hawkish signal is enough to rattle the market further. The AI story is not over. But this market is not going to be quiet anytime soon.